Well, speaking of spending, consumer spending nudged up by 0.1% in May, which was below consensus. But our next guest believes the consumer may have lost some momentum, but there's some strong growth underpinning future spending. Wages and salaries are up 0.5%, and that's the most since May, and personal incomes were up 0.4% in May. Let's bring in BMO senior economist Jennifer Lee to discuss this more. Hello, Jennifer. I mean, we kept hearing, at some point the consumer's going to pull back sharply. Haven't seen it yet, though. How would you characterize the state of the consumer right now?
Well, hi, good morning. Thanks for having me on. And by the way, I'm still picturing that cage match that you guys were just talking about. Overall, we have been continuing to wait for that U.S. consumer to pull back. But that saying about how you should never underestimate the American consumer still holds very strongly. They may be taking a little bit of a breather right now, but as you just pointed out, there is still a lot of strong underpinning beneath the consumer, and that's because of still steady wage growth. Because at the end of the day, it's for the U.S. consumer, it's all about having a job, having a steady income. You don't have to be spending every single penny every single month, which is probably a good thing. And you should probably be squirreling a little bit away for a rainy day. And that's what's going to help support future consumer spending. Again, you don't have to be spending every single cent right away. But as long as they've got some strong financial backing behind them, I think that bodes well for the overall consumer and for the economy as a whole.
And do we get a sense of how many are actually putting this money into savings while they're actually also sort of taking on more credit card debt and other consumer debt as well, in really trying to figure out what comes next for the consumer?
I think, again, this is like, as long as, I'm going to sound like a broken record here, but as long as that labor market remains still tight, not as tight as it once was. I think most consumers, broadly speaking, are still saving. You saw that in the latest May personal income and spending numbers, where you saw the savings rate tick up a little bit by a couple of percentage points. But of course, at the same time, you're still taking on. Everyone has credit card debt, or almost everyone has credit card debt. But again, because they're still saving some money away, putting some away, it supports future spending. And that's, again, at the end of the day, is what really matters.
And of course, we'll not only be hearing from the Fed getting some of those FOMC minutes, but also, of course, we're going to be getting the jobs report coming up at the end of the week. What are the expectations there?
So we are still looking for roughly 200,000 jobs, which is still in any given month a very strong figure. We're not going to see 500,000 gains anymore. That's definitely a thing of the past. But again, 200,000 jobs, roughly, jobless rate to be roughly similar to about 3.7%, which is well off the lows, but still very, very low, and still steady earnings growth, about 0.3 in the month, which is about a little bit over 4% year over year, which again, still strong. And this is it's almost like a Goldilocks scenario, where you don't want it to be too hot, but you don't want it to be too weak either. You just want it to be just right to sort of keep the Fed maybe not always on pause, because we are looking for that rate hike coming at the next meeting. But at the same time, we don't want it to be too strong for the Fed to start talking more hawkishly than it already is.
And especially when you look at action from the ECB, I mean, we're still getting that same hawkish message, it's not done yet, we still have more work to do. How does that factor into what happens with the consumer in the US, and perhaps with the Fed keeping an eye on what's happening with those other central banks?
I think that definitely impacts the spending, the plans for spending, the psyche, I guess, for all consumers. And this is not just for American consumers, but for consumers everywhere. Central bankers do not have to be constantly raising rates at every single meeting. Obviously we're seeing these pauses that are taking place, like in the U.S., in Canada, in the RBA, for example. But as long as they continue to speak hawkishly and warn that our job is not done, we will not rest until inflation is back to 2%. That will certainly help make consumers, I think, sort of think twice before they start spending more. And again, this is contributing to putting a little bit of money aside for a rainy day, because rates will continue to go higher, and they will stay high for some time before we start seeing them being pulled back. We look for more rate hikes in all the major central banks, but we don't look for rate cuts to start kicking in until probably sometime in 2024.
And hopefully consumers squirreling away some money then in preparation of that. A big thank you to BMO senior economist Jennifer Lee. Thank you for your time this morning.